Turning from those political climate plans to changes pledged by businesses, and today marks 1 year since the Business Roundtable's statement dumping its advocacy of shareholder primacy, which it had previously had, of course, in favour of stakeholder support, specifically with a focus on ESG. Let's bring into the conversation and discuss this Chuka Umunna, Executive Director and Head of ESG at Edelman, the communications business, and also, of course, former UK Shadow Business Secretary. We've talked to him many times in that guise. Chuka, great to have you on the programme in your new role for a new conversation. Let me ask you then if anything has changed. So 1 year on since the Business Roundtable made these pledges about taking into account the views of a wider group of stakeholders rather than just shareholders, has anything really changed amongst the signatories to that?
Well, I think it has actually, and good to be back on your show, Anna. Good to be back on Bloomberg. I think there are two things to this. First of all, were they right in what they said, those 181 US CEOs who pledged to take into account stakeholders, not only shareholders? And let's remember, part of their rationale for this was that if you don't take into account the interests of shareholders, of stakeholders, sorry, it will ultimately negatively impact on shareholders. And if you look at what has happened in the last 12 months, you've had ESG funds outperforming the wider stock market during the COVID-19 sell-off. We've actually had more research come out in the last few months showing that the majority of sustainable funds have beaten traditional funds. And then we have seen greater and greater pools of capital chasing ESG investments, despite the challenges that COVID has posed. So already, you know, we have had a massive increase in sustainable bond volumes. Social bond issuance has absolutely rocketed to more than double the total amount raised in 2019, already now in 2020. And there is strong evidence that corporates with a good ESG profile have proved much more resilient in the face of COVID. So on that front, all that data definitely vindicates what those Business Roundtable signatories said. And in terms of their own performance, there are a whole host of measures, whether it is paying sick pay where otherwise it wouldn't be payable, providing free PPE, investing millions to support communities. On that measure, you've seen, for example, 3 times more Business Roundtable signatories are 3 times more likely to give paid time off, for example, than the general average. And so on different measures, Just Capital have actually done a bit of research on this. They have actually put their money where their mouth is, but we've still got a long way to go. And the research that we've carried out through our trust barometer at Edelman shows that if companies don't, live true to these stakeholder values, actually the public and customers will punish you. They won't buy from you.
And Chuka, it's interesting, you mentioned some of the progress that has been made, and there is still a long way to go. And on that point, a couple of my Bloomberg opinion colleagues wrote a piece recently that identified some of the members of this group who signed this pledge who don't pay a living wage. This is mostly US-based research, but who aren't paying a living wage. And that won't be true for all of these businesses, of course, but maybe it is then for some, according to this piece of research. Is closing the gap between CEO pay and the pay of the broader employee base, is that something that will take these businesses closer to these ESG goals?
I think CEO pay will continue to be a controversial issue. There's absolutely no doubt about that. I think the key will be the overall level of wages amongst the workforce in a business relative to revenue and profit. And so I think that's always going to be looked at going forward. And of course, during COVID, we've had a huge resurgence of interest in issues of equality, particularly following the tragic death of George Floyd. And again, the research that we've carried out through our trust barometer has shown that, 60%, more than 60% of Americans are saying that they will either make buying or boycotting buying decisions based partly on the record of a company on these kinds of issues of social justice. And so if you don't do these things and the public perceive, perhaps, take CEO pay, if that becomes an enormous controversy, then it's not just that it's not great for your reputation, but actually you will see citizen customers acting with their wallets and simply not buying products from you anymore. I mean, look, here in the UK, a good example of an ESG controversy that there has been Boohoo, which is, you know, one of our fast fashion chains. Before they had this ESG controversy in the last 3 months, they were twice the size in market capitalization terms, and Marks and Spencer's, a big old British institution. After the ESG controversy surrounding the treatment of workers in its supply chain, it lost more than a third of its market capitalization. And there you could say, arguably, that was investors acting with their feet. And so increasingly, you're seeing these ESG issues that sometimes have been described as intangible and not necessarily purely financial, having a huge impact on the bottom line in your market capitalization.
And so is that influencing whether shareholders push back against this broadening of corporate interests? As companies try to take into account the interests of all of these stakeholders, are shareholders pushing back, or are they saying, no, actually, on a long-term view, our interests align with this broader definition of stakeholder interest?
I actually think it's more the latter than the former, because increasingly a company's ability to integrate environmental, social and governance factors into its decision-making is seen by investors as a proxy for prudent risk management. We do an investor trust survey in terms of what investors, money managers, portfolio managers are thinking, and that is the emerging consensus view. If you are not taking account of these issues properly, then you, in the end, the bottom line will be hit, shareholder value will be hit. So it's definitely much more the latter than the former. And I think we've seen a sea change, actually, Anna, coming out of this crisis, which has brought even more focus on ESG issues relative to when we came out of the global financial crash in 2008-9, where I think it's fair to say, you know, for example, in the financial services sector, a lot of people just sought to go back to business as usual and pretend that a global financial crash, which had led to deficits rocketing and the broader public having to pay the price for that, they thought they could just pretend that that hadn't happened. I think coming out of this crisis, it's quite clear that business is much more sensitive to its role in society and how it is perceived by citizen customers, which is why, you know, if you look here in the UK, corporates have been quite careful as to whether they take advantage of state support through this pandemic, because they know if they take advantage of state support and say 12 months down the line, there is a big compensation package announced for its CEO, or they want to do a big share buyback, or they wish to make big dividend payments. If they've taken state support, you know, only 12 months beforehand, that's going to be extremely controversial.
Okay, Chuka, thanks very much. Thanks very much for joining us. Chuka Umunna, Head of ESG Consultancy at Edelman and formerly Shadow Business Secretary in the UK. Thank you very much.